Since you are losing money every day, keeping it under your bed, you have to invest the money somewhere so that it grows faster than inflation, right? The inflation that central banks are targeting is in the range of 1 to 5%. So you ideally need some investment growing your money at greater than 5%. This is where financial markets come in. Historically, the investment which has performed better than others has been the stock market. The average returns that you can make once you invest in the markets is about 10 to 12%. So voila, you have beaten inflation. Okay, so you're ready to be an investor now. But what are you exactly investing in? You are investing in businesses. Businesses making cars, medicines, oil, and a zillion other things. But how do you prove that you are investing in the business? To solve this problem, the ownership of the company was broken down into small parts and made into contracts. Earlier, these contracts were pieces of paper which represented the ownership of a person in a company, and these pieces of paper were called share certificates. Now, currently, however, they are stored in virtual form called a dematerialized form, or DMAT in short. The basic contract here is simple. You receive partial ownership in a company via the shares that you get, and you are risking your money because you expect it to grow at a faster rate. In return, you give the company the money which it might need for expanding its business, launching new products, repaying existing loans, and many other purposes. So that's the broad exchange. But how does this all function in reality? First, let's take the analogy of the property market. When you want to buy and sell properties, you sell it through brokers, right? The property seller has his broker and the buyer has his own broker. These brokers connect and get the deal done. The share market is also a broker-driven market via entities called stock brokers. Entities like Zerodha, Angel One, Grow, Upstocks, and many more. A piece of trivia: why are they called brokers when they are making the deal and not breaking it? One theory is that it comes from the French word procure, which basically meant trader in Old French. Okay, so these are the stock brokers. Secondly, how does trading of these shares happen? So earlier it used to happen in trading rings. If you have seen any show from the 90s era of the stock markets like Scam 1992 on the show based on Harshad Mehta, you will notice people shouting, standing around rings to place orders for buying and selling. Where did they stand? In a building called the Bombay Stock Exchange. A stock exchange is a market for all brokers to buy and sell shares. It's like your nearest mandi. You go there and negotiate with your vegetable vendor. You say that I will pay 100 rupees for this vegetable. He will respond saying, no, I'll only sell it for 120. And finally, you'll settle the deal at 110. Similarly, crores of such orders are placed from all over our country via these brokers, both for buying and selling of shares. And whenever the price matches, the orders get executed. A major difference between the share market and the traditional markets is that there is total anonymity of who is buying or who you are selling to. Also, the whole system does not operate in rings anymore. It is now fully digitalized, and you can invest in companies sitting at your home via your stockbroker, who invests your money via their respective apps by placing orders on these stock exchanges. Now, after understanding this broad scenario of the market, let's come to the role of lawyers in the market. SEBI is the regulatory body which supervises the markets and makes regulations for protection of investors. If any entity breaches these regulations, there is a hearing which happens before SEBI, and lawyers from the financial regulatory team or the disputes team get hired to represent these institutions or clients. Further, the first time that the company announces to the public, "Hi everyone, we are raising money," that is called the initial public offering, or IPO. You will always hear from one of your finance bros, "Trust me bro, invest in this IPO." This full process is handled by financial institutions called investment bankers or merchant bankers. And for dealing with the legal aspects of filing all the papers and documents for the IPO, they consult lawyers from the capital markets teams of different firms. Also remember that it is the Securities Exchange Board of India, and securities are not restricted to just shares. Some companies are willing to give away ownership to get funds, while others might not. These companies can go for alternate ways of raising money, for example, a loan, which leads to the creation of another type of instrument or security called debentures. These debentures can also be traded on public markets, and for listing of these debentures, typically the banking and finance team of different law firms is usually hired. Moreover, if any company is already trading on the stock markets and another entity wants to acquire that company, or two companies wish to merge their operations to create a bigger business entity, then for such mergers between two companies and acquisitions of listed companies also, there is a general corporate team which advises different clients.